Welcome to this Killik Explains finance video. This week, a fairly topical one and a fairly obvious topic to take on. Why did the Woodford Equity Income Fund decide to suspend trading in its shares, or what I'm going to call units? And what are the ramifications for investors? Are there any lessons, any takeaways? We don't know what's going to happen next. Neil Woodford's working hard to see if he can reopen the fund in some way, shape or form, but as I make this video, it is temporarily closed for business. Now, the background is what? Well, after falling from a net asset valuation, if you like, assets under management, it's called, of around 10 billion in May 2017, a couple of years ago, Woodford's fund suspended trading in its own units. They're called shares, but they are actually units, as I'll explain in a moment, at around a 3.7 billion valuation. So the assets under management falling away, and this has resulted in a suspension of trading. Now, in the short term, this means investors are unable to buy or sell units or shares as they're known. And that's quite important because a lot of investors have sort of thought, well, what's going on here? If this was a company listed on the London Stock Exchange, I could buy or sell its shares, couldn't I normally, like a BP or a Tesco? So how come these things can suddenly suspend trading just like that? Well, it's to do with the way they're set up. They're not normal companies. They don't trade on the London Stock Exchange like companies do. And that means, as an investor, the mechanism is a little bit different. So how's this happened and what could happen next? Now, a recap on open-ended funds. This might sound a bit tortuous, if you like, but it's important to understand the basic structure and understand what's happened in the last few days. So, the Woodford Equity Income Fund, far from alone, is what's called an open-ended investment company. And this is one of the biggest fund types in the UK, if not the biggest in many ways. OEICs, open-ended investment companies. First trap is they use the word company in the name. So these are vehicles that invest in other things, like shares, for example, but they themselves are not companies in any conventional sense. You can't look up a share price at the London Stock Exchange. You can't buy or sell them between you and other investors via a broker in the normal way. And that's important. So being open-ended suggests it can grow and contract as investor demand dictates. And you might think, well, that sounds good, so it can expand as more people want to buy into it, contract as they don't. But structurally, there is a problem here. It means these things can get very, very big very, very quickly. There's nothing to stop a fund manager growing the mandate way beyond its original remit, if you like, and that is potentially as much of a problem as it is an opportunity. And although in theory they can contract as investors dump units, in practice we found out that actually there's a limit on how fast they can do that. Why? Coming up in a moment. So the structure creates a problem two ways. One is allows fund managers to go beyond, if you like, their original knitting and expand very quickly. And secondly, when lots of investors want to sell, unlike a normal company at the London Stock Exchange, all right, where the share price would just plunge, but you could keep selling if you like, here we've got a potential problem. Now, what is it? The basic mechanics. Stick with me on this one. This explains why Woodford had to effectively gate, as it's called, investors, stop them either buying or selling, in this case, more units. Now, basically, the mechanics are simple. This is like any fund. So a fund manager sets up one of these things, takes money from investors, buys a portfolio of investments which are going to hopefully perform according to the mandate, equity income fund or whatever it happens to be, and then manages supply and demand for fund units. And here's an important thing. These things may be called shares in an open-ended investment company, but they're not in any true sense. What do I mean by that? Basically, you can only buy and sell shares from and to the fund itself. That is done at a specified valuation point. It's not like buying a Tesco share where you can do it any time of the day in theory. All right, it's done at specified valuation points, and it's done at a value determined by the fund. There isn't an open market value in the way there would be with normal shares, for example. So, just to put some numbers on that, let's say a fund has been created in this style with assets of 100 million. How did it get assets of 100 million? Well, it asked investors to put money in, so it issued units, or shares as they're called, but I'm going to say shares like that, 100 million of them, and the implied price is £1. Why do I say the implied price is £1? Well, if you believe, if that's right, that asset valuation, all right, and that could be listed UK equities, it could be almost anything actually, then you take that, divide by that to get that. And that makes these things different to normal quoted companies, where the share price and the underlying net asset value can part company. You get discounts and premiums, not here. Now here's the problem. Let's imagine that you don't know, or perhaps you do know, that those assets under management are not all they appear to be. In other words, most of them are illiquid. They're in smaller, risky companies, and only 20 million's liquid. That's the stuff that's been invested in FTSE 100 big liquid shares, let's say. And you might think, well, so what? I mean, presumably the illiquid stuff is going to make better returns and so on. There must be a reason why the fund manager's done that. But here's the problem. If a load of sellers get nervous and want to dump 40% of the fund, 40 million units, I'm making up these numbers, by the way, purely for illustration, how is the manager going to meet those redemption requests, as it's known? Well, you might think, well, for starters, dump that lot. Well, that'll satisfy half the demand to sell, but where's the other half going to come from? Because to get 40 million of your unit holders out the door, you're going to have to try and sell some of that. And by definition, the fact these are illiquid investments suggests that dumping them overnight quickly to hit the next valuation point and meet redemption demand isn't going to be easy. And if you get a big wall of selling pressure like that, what a fund manager may have to simply do is close the fund, gate it as it's known, and stop, literally stop any more sales. Until what? Until he or she's had a chance to try and go out there and sell some of this stuff to meet redemption requests. It's not just a question of selling enough to meet the 40 million. You've got to sort of think in the back of your mind, what if there are even more sellers when I reopen, and I need to make sure I've got liquid investments, cash on hand, to meet those redemption requests. And of course, as the market gets wind of the fact you're trying to do this, it gets more difficult to offload the liquid investments, and things can sort of turn into a catch-22 spiral quite quickly. Not saying that's going to happen in the case of Woodford, we're going to wait and see, but you can see the potential. Okay? So what next is quite a good question. You can see from the mechanics there that you can get a situation where a fund manager has no choice but to suspend trading temporarily. Now, options therefore, the manager could sell sufficient assets to meet redemption requests. But if you were able to do that in a fund that was very liquid, then you wouldn't have to gate it. You wouldn't have to suspend trading. All right, this can become impossible sometimes, or difficult, or you can think, well, actually, that's not going to optimize investor returns overall. That's the argument used. So a risky alternative is suspending the fund's unit. Why is it risky? I mean, mechanically, it's not that risky, you might argue. It's because of the reputational damage it can do. People thinking, crikey, what's going on? How bad can it be? What will happen next? Well, if suspensions are sufficient to basically stem the flow, if people stop basically demanding to sell units in the fund, shares in the fund, then it may be that you can liquidate sufficient amounts of these illiquid investments to just sort of stabilise things. Or you may see another rush for the exit. If people start panicking, then you may see funds leaving, and in which case there'll be more redemption requests to meet. And in a worst case, a fund in this position could be, and I stress could be, heading for closure. We've seen funds in the past, commercial property sector for example, where gating hasn't necessarily solved the problem. It may do, but it may not. Takeaways for investors then. So what are you supposed to make of all this basically? Well, first of all, do understand liquidity risk. I talked about this at the beginning of the year in a video. 3 things investors should consider in 2019. Liquidity risk is not something enough investors consider. They just look at price risk, the fact that things go down as well as up. But that assumes you can always get in and out of a position. So liquidity is important. All right, and there are other videos where I deal with it more specifically. Consider whether your objective can be met with a closed-ended structure. There is another way to run a fund. It doesn't have to be through an open-ended structure. Open-ended structures have their pros and cons. I've done a video on this. There is a thing called investment trust company. That's a London Stock Exchange listed vehicle. It could have exactly the same mandate, potentially, as an OIC, as it's known, but actually you don't have this gating problem. What you get is discounts to net asset value, as it's called, as you would. So some investors will look at whether they can achieve a similar mandate with a different structure, and don't panic. There is a risk that the Woodford issues short-term get blown out of all proportion. What do I mean by that? Well, Woodford Fund seemingly suffered some specific style drift. In other words, he didn't stick to his knitting. He went into areas of the market where he is not necessarily the best expert. There are big areas in the market where he was an expert. Some of the stuff he was buying latterly, he may not have been. At 10 billion at its peak, it was tiny in the context of an estimated 50 trillion US dollars worth of funds in open-ended vehicles of some sort. There is a danger that the media make a bit of a mountain out of a relative molehill in fund management terms, And the laws of gravity normally eventually apply to star fund managers. Okay, what goes up tends to come down. I'm going to do another video on that in the future, watch out for that one. But it is the case. You have to be careful to make sure that the original mandate on which a fund manager has built their track record is still the one they're running later. Editor@killik.com with any questions, and if you'd like to see those videos that I talked about, then it's killik.com/learn, and look down here for the funds tab.